Welcome to DeFi Crypto today. Our topic today is DeFi option strategies, part one. We're also going to focus a lot on protocols that are on Optimism, although we don't really have to. I just think that Optimism has a lot of interesting opportunities, and I might as well show off what Optimism is about and the opportunities available. So, to review, because we did an Optimism video, the link is in the description below. Optimism is a layer 2 blockchain. Basically, that means it's sitting on top of Ethereum. Ethereum is the layer 1, and layer 2 is above it. And you can get your gas fees chopped quite a bit. So it's a lot cheaper to transact. There's a lot more speed as well. The transaction should be instantaneous and so on. So today we're going to focus on this protocol, which is native to Optimism. It's called Lyra. And Lyra is an automated market maker for options trading. It's relatively new. It's been up for a few months now. And you'll see that it's interesting because several of the protocols that are available on Optimism, make use of each other. So, for instance, what you're going to be able to trade on Lyra is basically options that are based on synthetic assets that have been created by synthetics. Okay, so you're going to be able to trade synthetic Ethereum, synthetic Bitcoin, synthetic Link, and you're going to use synthetic USD to pay for it. Okay, there are reasons for that. It's a lot more efficient. There's no slippage, so you don't lose money doing this. It's very, very efficient. All right. So, and if you're not set up for Optimism, well, you should. So you need your MetaMask, right? And you go to chain list and you type Optimism, and you connect your wallet. And once it's connected, you add to MetaMask. I'm already added, so I don't think it's going to pop up. But normally the MetaMask screen would pop up. All the fields are already pre-filled with all the data that you need to run on Optimism. Once you have that set up, you need some Ethereum because essentially it works like on the Ethereum network. The gas is paid in Ethereum, and there are several bridges. The one that I like to use is Xpollinate. All the links for this stuff is in the description below. You can choose whatever you want for bridge, but I like this one because you can choose from a variety of networks, okay, and send some Ethereum over to Optimism. So you could be on Avalanche, let's say, and you want to send to Optimism, and in this case, yeah, that's not going to work. Binance Smart Chain. Yeah, Binance would work better. So let's say you have Binance Smart Chain. You could send over some ETH, okay, from Binance to Optimism. Okay, and by doing so, you have gas on Optimism that you can use to pay for transactions. And you can also use your ETH to buy other assets, including the synthetic assets that we need to pay for our options. Okay, so this saves a lot of time. Now, one of the advantages is if you want to save on gas and you're using Binance, well, don't send your Ethereum to the Ethereum network and then bridge over. You could do that, obviously. You could do like this, right? And you could send over some ETH, right? Obviously. But the gas is going to be pretty high. So it's usually cheaper to send from Binance to Binance Smart Chain, and then from Binance Smart Chain to Ethereum using this bridge. Okay, usually the gas fees are a lot cheaper. So up to you. All right, so basically look at what's available, what you can transfer. Just make sure that you start by depositing some Ethereum on Optimism, and then you should be ready to go. After that, you can send USDC, USDT, or whatever else you want. Okay, whatever is going to be available in your wallet in here, you can send over to Optimism. Okay, so now let's assume that everybody's ready to do stuff on Optimism. But first, we need to understand what the heck are options and why we should bother with this stuff. Sounds complicated. It's a little bit more complicated than just buying crypto, but these are crypto options, so why not? The thing is that there's several things you can do. You can generate passive income with this stuff. You can hedge against the market going a certain way that you don't want. Okay, and so on. There are some risks, and we're going to have a look at that. Nothing is, there's no free meal anywhere. But you're going to see it can be quite fascinating. So today we're going to go really basic to try to understand what options are about. There's a lot of new terminology, so we're going to go over that. And you can skip ahead if you already know this stuff. There's going to be a lot of timestamps in the description below. Okay, so what are options? Well, most important thing to remember, options are contract and they allow you to do something. So the owner of the option has the right, but not the obligation, to buy or sell an asset at a fixed price. So that's all written in the contract. And that fixed price called the strike price. And it's good only for a specific period of time. After that, contract's over. The seller of the option contract has the obligation. Here you have the right, but not the obligation. Here you have the obligation to take the opposite side of the trade if and when the owner exercises the right to buy or sell the asset. So the owner decides what he wants to do. Okay. Do you want to buy or sell the asset at the fixed price for a certain amount of time? Yes or no? Once you decide what you want to do, then the seller is forced to do it. Is forced to comply and perform the opposite transaction. Okay? So the owner has the power here. Okay? Now there are two flavors of options. We've got call options, and the other one's called the put options. So the call options, if you're buying call options, they give you the right, but not the obligation, to buy a specific asset. Could be crypto, stocks, oil, gas, futures, indices, and regular currencies, not just cryptocurrencies. You can put anything on an option practically at a specific price within a specific time frame. Then you can also sell call options, and that gives you the obligation to sell a specific asset, crypto, stock, whatever, at a specific price within a specific time frame, if the call buyer decides to invoke the right to buy the asset at that price. Okay, so the buyer invokes the right, you have to sell. Now, call options give you the right to call assets away from someone. So, to try to remember why it's called a call, it's like you're calling the asset towards you. Okay, that might help you understand what that's about. And the other flavor is called put. So it's a put option. Buying put options gives you the right, but not the obligation, to sell a specific asset, crypto or stock or whatever at a specific price within a specific time frame. So you see, it works the other way around. Okay? If you buy a call option, you have the right to buy an asset. If you're buying a put options, you have the right to sell the asset. They work in opposite ways. You can also sell a put option, which gives you the obligation to buy a specific asset at a specific price within a specific time frame, if the put buyer decides to invoke the right to sell the asset at that price. So put options give you the right to put the asset on someone else's back. That might help illustrate the difference. Okay, call, you want it, put, you put away. So you can have all kinds of strategies, okay, with options. Now, most of the time, people don't just do a simple strategy. Typically, they combine things together. They combine, they don't use, they don't just buy a call or buy a put as a standalone strategy. That can happen, but it's not that common. Okay? So typically, you combine them with other crypto positions and other calls and puts based on the same crypto. You can also hold the crypto asset and so on. So we're going to see a little bit of that today. I'm going to go very basic. Okay. And we're going to see what we can do. Now, there are lots of keywords that we need to understand. Okay. So I'm going to spend a bit of time explaining what those words are, because we see them all over the place on option protocols. So, long. Long is a position of ownership. When you own something, you're long. So when you buy an option or a crypto or any asset, you have a long position on that asset in your portfolio. So if you're holding Bitcoin in your portfolio, you're long on Bitcoin. Short is selling a position without ownership. So you can sell stuff you don't have. Sounds weird, but that's normal in finance. Okay, especially with options and other derivatives. When you sell an option or a crypto or any asset without actually owning it, you have a short position on that asset in your portfolio. Now, the next key word here is strike price. That's the agreed price per token, I would say, at which the asset may be bought and sold under the terms of the option contract. Okay, so you're going to see that on Lyra today. They're going to have different strike prices. Okay, so you choose the price that you think is best for your strategy. It's also known as the exercise price. Okay, if you exercise your options, you exercise it at the strike. Then there's like more definitions about the money. Okay. So you can be in the money, out the money, or at the money. It's not that difficult. Basically, if you have a call option and the asset price is above the strike price, you're in the money. If you have a put option and the asset price is below the strike price, you're also in the money. Why? Because calls and puts work opposite ways, right? Remember that? All right. So now, out the money is when the call option, if you have a call option, the asset price is below the strike price. If you have a put options and the asset price is above the strike price, you're also out the money. The cost of out the money option consists entirely of time value. We're going to have a closer look at this in a moment. Then at the money, well, it's simply that whether you have a call or a put, the asset price is equal to the strike price. So if you have a strike price, let's say $3,000 for Ethereum, and the spot price, that the current price of Ethereum is also $3,000, you're at the money. If the price of Ethereum is, let's say you have call options, okay, and the strike price is 3,000, but Ethereum is selling at 2,800, then you're out the money if you have a call option, but you would be in the money if you have a put option, and the opposite is true. So if the strike price is 3,000 and Ethereum spot price is 3,200, then you're in the money if you have call options, and you're out the money if you have put options. Okay, I know a lot of weird terminology, but the more you play with it, the more it starts making sense. Okay, I'm learning this stuff as I go as well. Basically, I'm doing this very selfishly for me to learn about options, and as a side effect, you get to learn with me. So, because I haven't been trading options a lot, okay, so I'm trying to understand better how it works. And what's fun is that we can play on Lyra with tiny amounts of money just to understand how it works. Okay, there's no limit in terms of how small you can trade on Lyra. Okay, so you can experiment, try some strategies with like $20, $30, $50, whatever you want. Okay, just to learn how it works. Okay. All right, what else we've got? Intrinsic value. That's the amount an option, the amount that an option is in the money. Okay, so how much is it worth right now? That's the intrinsic value. The time value, that's the part of the option price that is based on its time to expiration. As we know that options have a limited lifespan, okay? At some point, they're going to expire. And that time value shrinks gradually over time until it becomes zero when the option is expired, okay? So you have, oops. All right, so basically you have the option price minus the intrinsic value is the time value. Exercise. The option owner buys or sells the underlying asset at the strike price and requires the option seller to take the other side of the trade. So you're the option owner, you decide to exercise your option, okay? The option seller is forced to take the opposite side, okay? That's what they call the exercise. Now, when the option owner exercises the option, the other guy, the option seller, is assigned, okay? So when and the assignment is when an option owner exercises the option, an option seller or writer is assigned and is required to buy or sell the underlying asset at the strike price. Okay, so there's always two sides for everything. Okay, it's never one-sided. Okay, so this is one of the most basic strategies. Okay, we're gonna have a quick look at that. We're gonna try to do it ourselves. Hopefully it's gonna work. I haven't tried it yet. I'm gonna use a super tiny amount. I don't have a lot of money that I put on Optimism for demonstration, so I'm gonna use a ridiculously low amount. But if you're not very familiar with options, number one, read about options and watch a lot of videos about options. Most of the information you're gonna find are gonna relate to stock options, okay? But there are a lot of similarities between crypto and stock options. What we're going to see though is that because crypto, DeFi, options are new, there's not a ton of choice. Okay. On Lyra right now, you only have 3 different assets you can play with. But as time goes on, they're going to be able to add a ton of other assets. Okay. Also, at some point, I'm going to show you other option markets that are available on other blockchains, so not just on Optimism. We're going to have a look. This is the beginning of our option series, okay? So I'm hoping that we're going to have several videos, and we're going to be able to play with options on other networks such as Arbitrum. And I think there's also on Solana and other places. So we're going to be able to play with options and use various strategies and see how it works out. Yeah, so read as much as possible. You can also, actually, what I'm going to do, I'm going to put some links for some of the books that I bought myself. The links are affiliate links with Amazon. Amazon gives me a couple pennies if you buy those books, okay? You don't have to click my affiliate links. You can buy them direct if you don't want to encourage the channel. That's up to you. But you should definitely read more about this if that's a subject that you find interesting. So I'm going to put a couple books that I bought myself that I'm using to understand options better, and I'm adapting those books to crypto here. All right, so the first one is writing covered calls. Writing, let's remember that writing means selling. Okay, all these terms that we need to be familiar with. So what does that mean, selling a covered call? So we're selling someone else the right to purchase an asset that you already own at a specific price within a specific time frame. So when we're selling or writing the call, we pocket the premium immediately. Okay, there's a premium, and we keep it. It's ours. Okay. Since you already own the asset, you're covered if the asset price rises past the strike price and the call options are assigned. Okay, so basically, you don't really want the asset to go up in value. Okay, a covered call is a little bit like you're a little bit bearish. Okay, you say, market's not amazing right now. I think Ethereum could go down a bit, or it's going to be trading sideways. But you don't expect Ethereum to go to the moon, okay? If you expect Ethereum to go to the moon in the next couple of weeks, don't do this. You're going to lose a ton of money, okay? So you simply deliver the asset you already own and reaping the additional benefit of the uptick on the asset. So you could make money if it goes up. You don't want it to go up too much. Okay. So roughly, so you choose the asset. In our case, on Lyra, we have 3 assets we can play with. We have Ethereum, Bitcoin, and Link. We pick a strike price that's out of the money. Okay. That means the price of the token did not reach that level yet. Okay, you want the price to rise before you part with the asset. We're going to pick a delta of around 0.3 or less. If you have a huge delta, your odds of winning this bet are very low. Okay, so by having a delta of 0.3 or less, our odds are more in our favor. Try to remember this. Don't forget, everything you do in crypto, and especially with options, it's a bet. It's a bet. There's nothing certain. You cannot predict the future. You're going to make a position. You think, well, this is what I expect. I expect that the price of Ethereum is going to go sideways, and might go up or down a little bit, but I don't expect it to go to the moon. Okay, good enough. And that's why we're writing a covered call, okay? Because that's the kind of strategy that we would use if those are our expectations, okay? Now, investors sell covered calls when they expect the spot price to stay choppy or slightly bearish. If the goal is to collect yield, then investors do not want the spot price to rise past the strike, as they'd be better off just holding the underlying coin. So, if you think that Ethereum is going to go to the moon, don't do a covered call. Don't sell a covered call. It's better just to hold the asset. Just hold your Ethereum, okay? Because you're going to make a ton of money with it, okay? Using this strategy, your gains are mitigated, okay? You risk losing more money if the price goes up too much, okay? That's the point. All right, what are the risks? There's a downside risk, which is similar to holding the token itself, holding spot. Selling covered calls still leaves investors exposed to downside risk, but it's partially reduced with the option premium collected. So we're getting a premium, okay? So that reduces the downside risk, okay? Now, there's an upside risk. If the crypto price goes up past the strike price, then the investors' profit in USD would remain capped, so that you'd be stuck at a maximum. Okay. Therefore, the investors would have been better off just holding the underlying token. Okay. Again, as I said earlier, if you think Ethereum is going to the moon, don't do this strategy. Just buy Ethereum and hold it. Best case scenario, the spot crypto price is going to stay just below the strike price. So you could be here, the strike price could be here, and the price of Ethereum could go right up to the strike price. Okay, very close to it. That's where you can maximize your earnings. Okay. The investor who sold the call will be able to keep 100% of the premium initially sold. Okay, and you keep the premium on top. Okay. So, more risk. Key point. If an investor is seeking to earn yield with options, he should be cautious on selling calls when a particular crypto is expected to pump up fast. Again, I'm repeating myself because it's very important. If you think the asset is going to shoot to the moon, don't do this. Just buy the asset. Okay, you'll make a lot more money. Okay, this is like a hedging against the price of Ethereum or Bitcoin or Link in these cases. Okay, going down a bit. You don't know where the market's going. You don't think the market's going to go anywhere fast. It's like going up and down, up and down, up and down a little bit like this. You don't expect a total crash. You don't expect shooting to the moon. You expect that it's going to play within a certain range. Okay, so that's what the strategy is for. You can make earn some yield, okay, which is the premium, by using this selling a covered call strategy. That's the point. Now, there is a higher probability that the spot will be higher than the strike at expiry, resulting in losses if you think the asset is going to pump to the moon. Okay, so let's make sure that that's clear. That's why I'm hammering this topic today. Okay, so this is the Synthetics website. Basically, the assets that are going to be available on Lyra are right here. You got SBTC for synthetic BTC, SETH, and SLink. Those are the three assets for which we can buy and sell options. Okay, so they're coming from this protocol. It's a very good protocol, been around a long, long, long time. They know what they're doing. Okay, all right, and this is. By the way, there's a lot of information about options directly on the Lyra documentation. Okay, there's an option primer. They give you, like they explain the Greeks. We haven't looked at the Greeks today. That's coming for another episode of this series. We're going to look at the Greeks and what they mean and how we can play with them. Okay, they explain about volatility. What does that mean? Explain option prices and so on. The pricing is based on the Black-Scholes model. Okay, Mr. Black and Mr. Scholes, and there's also another Mr. Merton, worked on the theory and the math for these things. Don't know if we're going to see the math. Yeah, see, you have these lovely equations here. Well, you don't need to know them before trading, thank goodness. But if you like math, you should definitely check this out, okay? And you can do the calculations and so on. All right, so yeah, definitely check out the documentation. They explain quite a few things. Here they explain why we're using synthetics, okay? It says synthetics provide zero slippage exchange, which means the AMM pricing is a deterministic function of the trade size. So because there's no slippage, you can trade small, you can trade huge amounts, and you don't lose money. The price is basically just a function of the size of the transaction, and it's using the Black-Scholes models to calculate the price. Okay, so it works exactly like in theory. Okay, it makes it super nice. Okay, because unlimited liquidity. Okay, they also use it to hedge LPs. You're going to see that you can do more than just trade options. You can also provide liquidity, okay, on Lyra and earn some Lyra token rewards and so on. All right, so this is the main page. If we go inside, this is what the ETH market looks like. So we've got ETH, we've got BTC and Link. One thing we notice, if we click on BTC, it's open. No, it's closed. Trading is closed on Bitcoin at the moment. I don't know why. I didn't check. I should have checked on Discord, but right now it's not available. Yeah, talking about Discord, definitely join their Discord. They have a lot of information. Start here, for instance. You have the official links. But what's very interesting, you've got the documentation we just saw right here. There's a blog, but the blog doesn't relate to trading itself. It relates to what's new, what's coming, and so on. And but this article is coming from Bankless, and it's a guide to option trading on Lyra. Okay, it's definitely worth a look. And obviously, they've got Lyra Learn. So if you have questions and you don't know what to do, they're going to give you links and they're going to answer your questions and so on. There's support in general as well. So you can discuss a lot of stuff directly here with people that actually work at Lyra and other users as well that have more experience than myself. All right. So yeah, and one thing that I found listed here, and I'm going to put the link in the description. I took some of the text from this guy who explains covered calls. Okay, Samit Chapal. So definitely you should follow this guy. It's very informative. This tweet has a lot of information about covered calls and why you should do them or not do them and so on. So the link is in the description below. You should definitely read that and check him out. Okay, so let's try a transaction. So as you can see, I've got a little bit of ETH, tiny bit of ETH in my account. And right here, we've got, you can buy or sell. Let's see if the numbers are going to show up. So you've got various options that are available, okay? First of all, you have the different dates. So you can choose, today is the day. Today is the 7th, so you got 4 days before these options expire, and you got a little bit more time and so on. So you've got 4 different expiry dates, and you also have various strike prices here. This is the spot price. This is the current price of Ethereum right now, 3,074. Okay. Now we want to be to have a strike price that's out the money. Okay. So basically, we want the strike price to be above the current price. Now we're gonna sell, and we want to because we're writing a covered call. Now, what you need to check is the delta. We said that we want a delta of 0.3 or less. Now, this is the premium. Okay, if you look at this here, the quoted price, the price to trade one standard size against the Lyra AMM. The price will be higher for larger size orders and lower for smaller orders. See the documentation for more details, so you could click on that to learn more. All right. So the price at the top here is smaller and gets bigger and bigger and bigger if the price is goes below the spot price. Okay. Now, if you look at this, you notice that the delta here is 0.86. That means it's very unlikely you're going to get this price. Okay. Now, what you should have a look at is anything here. See, this one is at 0.26. This one is at 0.38. So this one is over 0.3. So you got to look at the first couple of options. This one is at 0.155 and this one at 0.26. Okay. All right. So that's going to give you an idea. Let's say we want to sell the call. So we selected sell, we selected call, and we go here, we click on this. Okay. All right. Now it shows here, okay, the expected profit and loss of $42.09 right here. Okay. Now, here's something that's in the documentation. Let me see if I can fetch it for you. Okay, they talk about covered calls right here. Okay, if you go in the options primer, they talk about covered calls. So let's say, what's the difference between a covered call and a naked short call position? And it says a covered call writer owns the underlying asset and a naked short call writer does not. So we're covered because we own the asset, the underlying asset for this option. Okay. If we don't own this, then it's a naked short call position. The thing is, the way the protocol Lyra is designed, by default, if you sell a call, it's going to be covered. Okay, so it is a covered call by default. So it says here, in Lyra's system, to sell a call, you must collateralize it with the underlying asset. This turns every call sale into what's known as a covered call. Okay, a covered call differs from a naked short call where the option is partially collateralized by cash and not the underlying asset. To write a covered call, the writer must first purchase the underlying asset, which means they are the loan asset itself. The accompanying short call position offsets this somewhat, but unless the call is 100 delta, the option seller remains net long the underlying asset, whereas they would be net short with a short call position. Okay, so a covered calls chart would look like this. Okay, you have a limited loss. Okay, this is the price. Here they say stock price, but that should be the token price. Okay, so in the red here, you're losing money. In the green, you're making money. And you notice that you're capped. What does that mean? It means that you cannot earn more than this. You can lose all your money, everything you invested in, okay? But you cannot earn more than a certain ceiling, okay? All right. So the price, the middle here is the price at which you break even, okay? And then the price can go up and the price can go down. If the price goes down, you can lose this. If the price goes up, you can earn that. Okay. I wish there was a way to stop this animation, but there isn't. All right. So the graph here, unfortunately, is not the same as the graph we've got there. Sorry, this page here. All right. So here we've got Ethereum, and it says 1 ETH. I don't have 1 ETH to play with, so we're gonna go with tiny amount. But I just want to demonstrate. I'm not doing this seriously. I'm just demonstrating how it works. Now, as I said, use small amounts if you're trying to learn how to play with this. Okay, so you don't lose too much money if the market goes against you. Okay, now here you notice the graph is very different. For some reason, they don't seem to take into consideration that you have a collateral that's locked. Okay, you need to have the asset in your wallet. So what we're going to do, I'm going to go 0.01. Okay, tiny amount. Okay. And I wonder if it's going to buy me the SETH or not. So let's play with this and see what happens. So I'm gonna swap for SETH. Okay. So it's taking 0.01 something. Allow 1 inch. So right now it's using 1 inch to do the transaction automatically. Okay. You don't need to go to 1 inch first. It does it for you. So we're gonna allow the transaction. Okay. Gas fee looks really low, and let's see how fast it goes. See, that's fast. It's never this fast on Ethereum, trust me. All right, so now we're going to do the swap. Pay some gas again. Okay, and it's doing the transaction. So it's taking, it's swapping 0.1 ETH for SETH. Okay, and that SETH is used as the collateral, and that's why it's covered. Okay, so now we want to allow Lyra. So it says here, you must allow Lyra to buy and sell options. You only need to do this once for each market. Allow Lyra to use your SETH. So at first we didn't have SETH. Now we have SETH that we're going to use as the collateral. Okay, and it's going to lock it here. 0.01 SETH. So we're going to allow Lyra to take that ETH, that SETH. We confirm that. I hope it's going to change the graph. I haven't seen it yet. Okay, transaction successful. At some point, we should be able to sell that call once the system wakes up. I need to click again. I thought I did it. Not this. So it's approved. I thought we did this. All right, is it going to work or not? Okay. Now that's what we wanted to see. Trading for this option can be disabled when certain thresholds are reached. whatever. So let's go with sell the call and we confirm. So there's a lot of steps because I didn't have SETH in my wallet originally. Okay, so I need SETH to cover the call that I'm selling. Okay, so we're doing all that right now. We've got our trading history right here, and I think we're done, right? We were short 0.01 ETH calls. Okay, let's look at my positions. Okay, so portfolio of my tiny transaction. Right now it's worth 33 bucks. All right, so we put 0.01 ETH, okay, as the SETH actually that we use to cover the call, okay, and that's it. Right now we lost 2 cents on this so far. Hopefully we're going to be able to make a profit at some point. What does it show if we click on this? Okay, so by clicking on this, it shows the history and it shows the detail of the transaction. All right, so we're not going to go through all these details because there's a lot of Greek letters here, and that's coming for another video later. We're going to explain what the Greeks mean and so on. But anyway, this gives you an idea of how to create to write a covered call or sell a covered call, okay, and why we want to do that in some market conditions that can be very profitable. Okay, it's not profitable in all market conditions. If you expect ETH to shoot to the moon, not the best strategy. Okay, probably best to just hold ETH in your wallet. Okay. All right, so that's it for this video. If you like this kind of stuff, please like and subscribe. Don't forget to ring the bell. Download the free book. All you have to do is click the link below and you put your name, your email address, you hit the submit button, and then you get a big fat button that says download the free book. If you miss that button, we're going to send you an email that says download the free book. And if you don't want to download the free book, well, go to Amazon, pay $5.99 to Jeff Bezos and Jeff Wells, send me a whole $1. See ya.